Buying a home in California just got interesting yet again. The California Dream for All program is officially back. Registration just opened. And if you're a first-time home buyer in the state of California, you need to understand exactly how this works before you jump in, because on the surface, it sounds incredible. Up to 20% for your down payment, up to $150,000 in assistance. No monthly payments on that second loan, but here's the thing. This is not free money. And if you don't understand how the shared appreciation works, this program could either be the opportunity of a lifetime or something you regret 5 years from now. So today, we're going to break down how California Dream for All works in 2026, who actually qualifies, what has changed from the original version, how the shared appreciation gets repaid, and who this program is actually for. So let's dive in. I think it's important to start by talking about what California Dream for All actually is, because at its core, Dream for All is a shared appreciation down payment assistance program through Cal FHA. It provides up to 20% of the purchase price, capped at $150,000, to help you with your down payment and closing costs. It must be paired with a Dream for All conventional first mortgage. That's important because this is not FHA, this is not VA, this is conventional underwriting, which means you must qualify based on conventional guidelines. Credit, debt to income, employment history, all of that matters. Now here's one of the biggest changes from when this initially rolled out. This is no longer first come, first served. You must register for a voucher. Applicants are selected through a randomized drawing. Registration is open as of February 24th, but here's the thing. It closes on March 16th at 5 o'clock p.m. Pacific Standard Time. So this isn't about being the fastest to apply. It's about being eligible and prepared. Now, before we dive into who actually qualifies, do me a favor and hit that thumbs up if you find any value in my videos at all. And if you want to stay updated on everything mortgage and real estate related, please consider subscribing to the channel. Now, here's the thing. Everybody hears free money, $150,000, up to 20% of the down payment, and people get really, really excited. But let's actually talk about who qualifies and then who may not qualify. So I want to go through each requirement one by one before we talk about anything else, because this is where the details actually matter. Let's start with the first thing. One borrower must be a first-generation home buyer. Now, this is a big one because people don't actually understand what it means, and it could knock you out right from the start. But what it means is first generation generally means your parents did not own a home, or in some cases, you were raised in foster care. Now, this is where people get tripped up. If your parents owned a home at any point while you were growing up, you may not qualify. Now, this is not a casual checkbox because the application requires information about your parents. It's going to ask their names, it's going to ask their date of birth, possibly documentation, proof of relationship in some cases. So this program was specifically designed to help people who did not grow up with home ownership advantages. But on the flip side, if you're the first in your family to buy a home, then this program was built with you in mind. But if your parents own property, even if you personally never have, that could disqualify you. So do not assume. Make sure you verify with the lender. And that's where I want to kind of go off on a tangent here for a second and make sure you're working with a lender that actually understands this program, can walk you through the ins and outs, the pros and cons, and help you make a decision whether it's the right loan program for you or whether or not you even qualify for it. In fact, our team and I have helped a lot of people go through this process. We'd love the opportunity to help you too. You can reach us using that link in the description. Now, the second thing I want to talk about is all borrowers must be first-time home buyers. Now, understand this one is pretty straightforward, but it's still important. Every borrower on the loan must be a first-time home buyer. Now, first time usually means you have not owned a primary residence in the last 3 years. So if you owned a home 4 years ago and sold it, you still could qualify for this program. But if your spouse owned a home 2 years ago and sold it, that could disqualify the entire file. Everyone on the loan must meet the requirement. Unfortunately, there are no shortcuts here. So if you're thinking about adding a co-borrower to help qualify, make sure they meet that requirement too. The third thing is one borrower must currently live in California, which basically means they must be a California resident. This is state-funded assistance. It's designed for current California residents. So if you live in Nevada and want to move here using this program, that's not how it works. You must already reside in California. And you're wondering, how are they going to know? It's because the lenders will verify residency. Simple rule here is if you don't currently live here, you probably don't qualify. The fourth thing is household income must fall within the Cal FHA limits. Now, this is where a lot of people get surprised. It's not just your income, it's the total household income. If two borrowers are applying, it's combined income. And each county in California has its own income cap. Now, some counties are higher than you think, but many households that fill middle class in California will still exceed the limits. And that's because it's designed for a specific income band. So before you get excited about the 20% assistance, make sure you check your county income limits, because if you're over the cap, you're out. Now, I put a link in the description of the video where you can actually check those Cal FHA limits. Now, the fifth thing is you must obtain a Dream for All lender pre-approval letter. Now, this one is not optional. So before you register for the voucher drawing, you must have a Dream for All lender pre-approval letter. And here's the thing, not every lender can issue one. They must be Cal HAFA approved and offering this program. That means your credit will be pulled, your income is going to be verified, your debt to income ratio is going to be calculated, and your employment is going to be reviewed. You must qualify for the first mortgage on your own strength. The down payment assistance, it does not fix weak income. It does not fix unstable job history, because the state here is helping you with the down payment. They still expect you to be financially capable of sustaining the mortgage. Now, as I mentioned earlier, if you need that Dream for All pre-approval letter, use that link in the description of the video. You can get in touch with our team. We're approved to do Cal HAFA. We're approved to issue those letters, so we can actually help guide you through that process. Now, the sixth thing is you are required to complete a 1-hour Dream for All education course. Now, it's going to cover how the shared appreciation works, when the repayment is being triggered, what happens when you sell, what happens when you refinance. And honestly, I think it's a good thing, because too many people hear 20% down payment assistance and then they just stop listening. And I think it's important because you're agreeing to share appreciation. You need to understand what that means long term. The course is online, it's free, it takes about an hour. So if you're serious about buying, that's a small investment of time. Now, with that said, let's talk about how the money actually works. And let's use real numbers. If you're buying a home in the state of California for, say, $700,000, Dream for All is going to give you 20%, which is $140,000, which basically means you're financing $560,000 on your first mortgage. That $140,000 that they're giving you, it's a silent second, which basically means there's no monthly payment, there's no interest accrual, nothing due until you sell, until you transfer the property, or you pay off the first mortgage. But with that said, let's fast forward. Let's say 5 years later, your home is now worth $800,000. That's $100,000 in appreciation. So let's say you decide to sell that property. In that case, you're going to repay the original $140,000 that they lent you, plus a share of the appreciation. Now, if you're in the moderate income category, that share is typically 20%. So 20% of $100,000 is $20,000. So in total, you're going to repay them back $160,000. On the other hand, you're going to keep the $80,000 in appreciation. But let's say you're in the lower income category. In that case, the appreciation share may be closer to 15%. So the math improves slightly in your favor. So what you're probably asking yourself right now is it worth it? And here's how I look at it. If this program allows you to stop renting, lock in housing, stabilize your monthly payment, and start building equity, and you plan to stay long term, I think giving up 15 to 20% of the appreciation may be a very fair trade. But if you're planning to move in 3 to 5 years, you probably need to think twice, because this program is built for long-term homeowners. In my opinion, I would say a 10-year time horizon minimum. Now that we've gotten that out of the way, let's talk about the 90-day window, because there's another thing you need to think about here. If you receive a voucher, you typically have about 90 days to find and secure a home in California. And understand, from a real estate agent that's been doing this for 20 plus years, 90 days sounds like a lot of time, but it's not a long time. So if you're applying, you need to be ready, which means you need to get your credit cleaned up, you need to be pre-approved, as we mentioned earlier, you need to have your documents organized, and you need to have a game plan in place, which means you need to have a real estate agent that you're already talking to, and you need to have a game plan in place, which in my opinion means you need to also know the realtor that you're going to move forward with. after you get pre-approved. Now, if you're watching this and not sure where to start, my team and I would love to help you on the real estate side as well. Not only can we help you get the loan, but I can personally help guide you through the real estate process myself, or I can pair you with one of my lender partners if you're not in the area that I cover. Either way, make sure you use that link in the description. You can get in touch with us for the loan as well as the real estate side. But the key thing to note here is this is not something you figure out after you win it. You need to figure out the details before you actually win the lotto, if you will. So with that said, let's talk about the pros and the cons of the Dream for All program. And let's start with the pros. First off, you get massive leverage. Small down payment here that essentially isn't even coming from your, I guess a larger down payment, up to 20%, can come from another source. So you're leveraging, the total amount of that property based on a down payment that you're not even putting down. The second thing is reduced upfront cash requirements. So the down payment is coming from, a third party. If that covers the down payment and the closing costs, essentially you're coming up with no money out of pocket. In some cases, if it's just covering the down payment, then you're coming up with the money for the closing costs. But either way, it's reduced from a traditional purchase. And the third thing is you get to potentially avoid mortgage insurance if that down payment is enough to get you to an 80% loan to value. And the fourth thing is you get access to home ownership in a high cost state. For the right buyer, this is super, super powerful. But on the flip side, there are some cons. The biggest one is that you give up future appreciation. Second thing is you must meet strict eligibility requirements. As we said, there's income requirements. There's certain things that you have to meet in order to qualify. The third thing is you must qualify conventionally, as we said earlier, a little bit tighter debt to income ratios than FHA, just a little bit stricter requirements when it comes to credit, that sort of thing. So it's going to be a little bit more difficult to qualify, but if you do qualify, it's an awesome program in my opinion. And the fourth thing is limited funding. Not everyone that applies here is going to get it. Remember, it's a lottery and it's not first come, first serve. You just need to put your name in the hat, and if it gets picked, fantastic. Remember, you only have 90 days to find that property, and or if you don't, you could lose that funding. And the last thing is you have to have that long-term mindset like we mentioned earlier. So if you're asking who is this for, it's for first-generation buyers, true first-time home buyers, California residents, income qualified households, as we mentioned earlier, and those long-term planners. It's not for investors, short-term move-up buyers, people unsure about where they're staying over the next couple of years, buyers stretching their budget too thin. Now, I realize you're probably watching this going, this program sounds amazing, and for the right person, it absolutely is. The key thing to understand here is this is not magic. It doesn't replace financial stability. It doesn't replace planning, discipline, long-term thinking. If you're considering applying, make sure you use that link in the description of the video. Talk with our lender who's CalHAFA approved, and he can guide you through the process. With that, you're going to get pre-approved. You should take the course, and you should run the numbers with and without the program, and then make a decision based on facts, not hype, not FOMO. And lastly, if you found any value in this, make sure you hit that like button. And if you want our team to run real numbers for your scenario, make sure you check that link in the description.